market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Verdon in London. We begin this morning with shares in SoftBank falling as much as 13% after reports that OpenAI may postpone an initial public offering until next year, delaying returns for its Japanese investor. The New York Times reports that the ChatGPT owner was warned volatility in tech stocks may dampen enthusiasm for an IPO. So with us to discuss this and other big tech news this morning is Bloomberg's senior market strategist, Neil Campling. Neil, good morning. Happy Friday. I do wonder how much this delay raises questions about the pace of AI commercialization. Does it take the pressure as well off Anthropic?
Morning, Lizzie. Yeah, it's an interesting development because clearly we'd heard before that OpenAI were on track to come to the market later this year. The story suggests that the CEO Sam Altman wants to protect the $1 trillion valuation target that he's hoping to achieve. Now, by delaying this, clearly coming to the market is an easier way to raise capital than and quicker often than in the private markets. So perhaps it holds a bit of an advantage to Anthropic, who still seems to be on a path to IPO in the second half of the year. And there are, concerns around this because of the amount of money that's being used to invest in these massive hyperscale tech ecosystems. So if we think about it, we've heard that the cash burn at OpenAI increased eightfold last year. They burned through $38 billion was the net loss for last year, and it's highly unlikely to slow anytime soon. So delays to an IPO certainly adds to concerns about how they will fund the massive expansion that's required for their AI ecosystem, and especially as SpaceX has already had that success in terms of coming to the market, raising substantial amounts of money with designs on creating these data centers in space in future years.
And Neil, the other big story in tech this morning is Apple raising prices across some of its products off the back of chip price increases. Of course, Apple products really ubiquitous, so perhaps there's going to be an inflation impact. But how big a signal are these price rises for the tech sector?
I think it's a wake-up call in some respects for the sector and also, unfortunately, for us as consumers. Because Apple before hasn't been impacted by price increases. We saw with massive disruption around COVID that Apple still had significant purchasing negotiation power with all of their component suppliers across the chain. This time, looking at increase of 20% for core products suggests that that's no longer the case. So if the company with the biggest purchasing power is now struggling, then others are going to struggle even more. And then for Apple itself, is there going to be a demand issue when they come out and likely launch the iPhone 18 probably in September this year? So that weighs on sentiment for the entire ecosystem, I think, for tech. And unfortunately, I suspect us as consumers are going to be asked to pay more for these perceived must-have products going forward.
Not what we want to hear. Neil, thank you so much. That's Bloomberg's Neil Campling. Have a great weekend. And now I want to turn to the market impact of all of this. We can go to Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. He joins me in studio. Good to have you, Christian. So, I was talking about the moves on the Kospi, down 5.8% this morning. How worried are you about tech? How much of a harbinger of wider doom are the Korean moves, even if, they are in context of big gains earlier in the year?
Yeah, you always want to kind of look at fundamentals versus positioning and sentiment. And I think we just have a very bullish sentiment right now. Our risk appetite indicator is above 1, and it massively increased in the past few weeks. And it started out, obviously, with the AI capex and that boosting earnings. But recently, the hopes for the Middle East war to come to an end, the Strait of Hormuz reopening, has created this Goldilocks backdrop of falling inflation expectations coupled with a relatively good micro earnings growth story. So sentiment is bullish, and when you have bullish sentiment, it isn't necessarily a reason to be bearish. Like when everybody's bearish, you want to be bullish, but when everybody's bullish, it doesn't automatically mean you want to be bearish, but you have the risk of setbacks and corrections if the market doubts these drivers.
But does it mean that you want to diversify away from the hyperscalers then?
Well, the hyperscalers haven't really done that well. If you do actually look at the Mag 7, they, both from a positioning point of view and from a performance point of view, they have not been leading the market higher. It's really been the semiconductors, the AI capex beneficiaries. You could even argue, if you continue to see the momentum in AI to be positive, you want to diversify towards the hyperscalers, maybe diversify away from the semiconductors, because they are the really volatile part of the AI capex spectrum. These are incredibly cyclical companies. They have a lot of positioning. They have a lot of leverage in the investor space, levered ETFs, options. So to some extent, it could make sense to diversify a bit away from them.
OK. Well, so tech volatility has been one big theme of the week. I also want to look all the way back to Monday when, of course, we had Keir Starmer resigning. And now that we know perhaps that we're going to have Andy Burnham as the next Prime Minister rather than a protracted leadership battle, are you looking at the UK as a bit more investable again, especially when he's got familiar faces, ex-Goldman people advising him on economics?
Yeah, it's very early. It's tough to say. It really depends on the policies that come out of the new government. But what I would say is there's been negative inflation momentum everywhere globally because of falling oil prices, and the gilt market always has a higher beta to that. So you've seen quite a bit of relief on longer-dated gilts, which to some extent set you up for a slightly more stable market environment for the new government, because it would have been one thing if you have a continued Middle East war, continued worries about inflation, the BOE hiking, which then puts pressure on the fiscal situation. But now that you actually get a bit of relief coming from global factors, nothing to do with the UK, you actually have for that UK government hopefully a more stable situation to start with.
So we shouldn't misinterpret it as relief that it's Burnham, relief that it's a faster transition, but actually know just that he might have a better backdrop that he's inheriting. Yeah. How much room then does he have for manoeuvre when it comes to rewriting the fiscal rules? How much is he going to be able to get away with?
There's a lot of nervousness about fiscal sustainability with our investors, and it's not just for the UK, for every country in the world. I think it's one of these structural imbalances that has been building over the last few years, since COVID really, when countries had to spend a lot of money, and since then there has been very little fiscal discipline. So for the US, for the UK, for all the countries, we have a lot of investors constantly asking, how is this fiscal debt situation going to play out? And in summary, it probably means in the long run, longer term, higher risk premia in bonds. And you have the occasional bursts where the market does these repricings, forces the situation. And as a result of that, for politicians, it's quite difficult to not essentially create such a burst of fiscal risk repricing. So I think, like, at the margin, you're quite constrained, I would say.
What about if the monetary mandate is changed? You know, there's speculation that, well, I mean, it's not even just speculation. The likes of Jim O'Neill and Lou Haig are talking about changing the mandate. Jim O'Neill's written previously that the BOE should target GDP instead of inflation. Would the market be kind of petrified that the Bank of England's taking its eye off the inflation ball if that were to be enacted?
I mean, any time central bank frameworks and reaction functions change, there's nervousness. We see this with Kevin Warsh starting as a Fed chair as well. What I would say is, however, that there's two major outlets for fiscal concerns. One of them is the bond market. The other one is the currency. So the question is always, if these changes are being made, will it actually translate into more rates upward pressure or currency downward pressure? And it really depends how these kind of policies are being articulated. But if you're targeting higher nominal GDP growth, that's consistent with higher nominal yields. So it would probably be at the margin kind of weighing a bit on the gilt market.
OK. Well, I want to come back to the Fed in just a moment, but let's just take a look now at the geopolitics. Stay with me, Christian. We'll come back to you in a moment. Oil tankers continuing to cross the Strait of Hormuz despite a container ship being hit by a missile yesterday. It's the first reported attack since the interim peace deal between the US and Iran. So let's get more now with our Bloomberg Horizons Middle East and Africa anchor, Abir Abu Omar. Abir, good morning. Just talk to us about what we know about the attack and the impact that it's had on traffic. Is it going to deter ships going through the strait when we don't know yet if anyone's taking responsibility for it?
Good morning, Lizzie. Well, we know the attack has happened. This is as far as our knowledge goes. No one has taken responsibility for who attacked, or no one has taken responsibility over the attack. The Wall Street Journal did report earlier that it could likely be the IRGC, but again, no confirmation yet. The U.S., from its side, had said that it's too early to point fingers, but the Ever Lovely, which is the medium-sized vessel that was attacked this morning, has made its way out of the Strait of Hormuz, despite suffering some damages to its infrastructure. What we're seeing across the strait generally today, Lizzie, is that yes, there are some ship owners that are taking a little bit more cautious steps when going through the Strait of Hormuz, but it hasn't really affected or derailed the slow movement or the slow return to normalcy across the waterway. Now, what we know is that this attack could have happened by the Iranians because the ship had not taken the proper routes that Iran had set out. It really took a route that was close to the coast of Oman, and Iran has been trying to tell ships to go close to its borders in order to be able to monitor those movements through the Strait of Hormuz. Just something to bear in mind here that Iran has maintained throughout the past 2 or 3 months, Lizzie, that it will toll the Strait of Hormuz. It said in the latest round of talks that it will toll it right after the 60-day period. A rebuttal from the U.S. through Secretary of State Marco Rubio said it was completely unacceptable for the strait to be tolled or have any fees there after the ceasefire negotiations take place.
Abir, thank you for the update. That's Bloomberg's Abir Abu Omar. Now, let's bring Christian back in. Christian Mueller-Glissman, Head of Asset Allocation Research at Goldman Sachs. So you've got oil prices falling, Christian, this morning. We're at $73.35 a barrel right now. But then when you look at the broader US economic data, they tell a story of American resilience. So where does that leave the higher for longer narrative?
Yeah, it's a really good point you make there. If you currently look at the 2-year yield, it's been remaining pretty range bound and hasn't really come down that much, whereas two-year break-even inflation has been collapsing. So you start to see a bit of a narrative change with regards to rates only reflecting inflation. There's a change in the reaction function. There's a certain resilience in the U.S. economy, which makes you wonder what the real neutral rate is potentially, because the U.S. economy is doing absolutely fine, despite the Fed funds rate possibly being higher than what most people consider neutral. But I do think that hikes right now will be probably a bit of a headwind for equities, and there's 2 reasons. I think one of them, there's already quite a bit of concern about capital availability. I mean, you mentioned earlier the IPOs being pulled. That certainly the capital availability is a core part of the AI ecosystem and the capex spend. So like pushing up the cost of capital and rates is certainly something the market might be nervous about. But I think more important for equities might actually be the central bank put. Like if you have a central bank that's on hold, like it will be ready to act if needed. But if you have a central bank that actually hikes, the hurdle rate to actually shift to cuts is a bit higher. And that means equity investors might require a bit more risk premium.
Well, yeah, just in the bond space, you know, if we isolate the data from yesterday, the PCE number, yes, it's not bad for where economists expected it to be, but it was still the annual increase, the highest since 2023. So, you know, is the market just putting too much faith in Kevin Walsh, the hawk?
Yeah, I mean, listen, I think the baseline has to be that kind of the trim mean and a lot of these measures that take out energy, maybe electrical equipment, they have remained very anchored and you come down. But every time you set inflation into motion, there's a certain autocorrelation, there's a certain trend, there's spillovers. And I think Kevin Walsh has very clearly said that markets should be guided by the data. That means now the market has a broader distribution because inflation forecasting is very difficult, spillovers, all kinds of things, and possibly the reaction function and the guardrails aren't there anymore. And maybe that's why you have a bit more risk premium on the Fed pricing.
Okay, Christian, really great to have you with us this morning. Christian Mueller-Glissman, Head of Asset Allocation Research over at Goldman Sachs. Well, coming up on The Pulse, what's driving deal-making in Europe? We'll discuss the outlook with KKR's co-head of European private equity, Philipp Freise. That conversation coming up next. This is Bloomberg. equity industry is holding out for a strong second half of the year after a disappointing first 6 months. Market uncertainty and fears that AI will disrupt software firms have limited buyouts. The sector has slumped since the Fed began raising interest rates in 2022, slowing deal making and making it more difficult for private equity firms to raise new funds. We can discuss the outlook for Europe, in particular with Philipp Freise, KKR's co-head of European private equity now, who joins me in studio. Hello, Philipp.
Good morning, Lizzie.
So you've always been bullish on Europe, but, we were just discussing some of the political instability that we've been seeing recently, particularly around number 10 Downing Street. Are you any less optimistic in general about Europe because of it?
Lizzie, as I have said before on this platform, I'm an optimist about Europe. We are long-term investors, so what matters is the direction of travel. We are very well versed to deal with the volatility of different prime ministers, of different administrations. In fact, it's our 50th anniversary this year.
Oh, congratulations.
So I would say I'm not at all less optimistic than I was before.
OK, but why is Europe even relevant when you've got the US, increasingly benefiting from this massive AI boom? Today's not the data point to Korea, but it's an exciting story in Korea and Japan,
right.
China. Why Europe?
So a very good question, especially today, after what we saw happened yesterday, where markets realized it's not only going in one direction with the AI boom. Because long-term investors really need to diversify. And Europe is still the second largest economy in the world. It's large, it's diversified, and most importantly, it just needs a lot of change. And what we do in private equity is actually help Europe to change.
But why would I want to do that in private markets when, in public markets, you've had an extraordinary run? I could get juicy returns out of the S&P.
So there's three points, really. The first is you put your finger on it. In the US, the public markets have incredible tech content. In Europe, if you look at the public indices, there's just not as much tech. So if you want to participate in sectors that are exciting, then the private markets are great. Yes, of course, there are exceptions. As today we are IPOing OHB in Bremen, I'm sure we'll talk about this. That's a company that's exciting the public markets.
Yeah.
The second reason really is that in private markets, you can affect change just more patiently. And what we do is we partner with entrepreneurs, families, corporates, and we transform them as far as tech is concerned, the energy transition, internationalization. If you do that in the public eye, it's just so much harder. And then the third reason, really, in terms of geographic diversification, why do you want to be in the markets in Europe? It's just a really interesting opportunity when you start from a lower base. Okay, you put your finger on it. We are behind the Draghi report, talked about this. But that gives us the opportunity to improve. And the financial investments look for the marginal change, not for the absolute, really.
Just before we get to OHB and the exciting things that are happening in European space, everyone talks about the winners and losers in private equity. When are we going to start actually seeing those losers failing, disappearing, merging?
Well, you're right that we are in an era of differentiation. In your introduction, you talked about how private equity was struggling. I would say, in fact, private equity is just more differentiating. For us, for instance, we're raising $2.5 billion of capital every week. We raised $130 billion in the last 12 months. We have invested $15 billion or so already in the last 12 months, and we have exited companies, sending $25 billion back to our investors. So I would say you just see bigger differentiation. We don't feel at all that this is a bad time for private equity. In fact, this is the time when you can really lean in. OK,
so let's say I want to lean into the European space sector.
Yes.
Apart from OHB, right. What's exciting to you?
Well, first of all, OHB is just an example for a long-term trend. Some time ago, we bought MTU aero engines from Daimler Chrysler at the time, and then we bought the defense and electronics segment of Airbus. We made both of them proud European champions, again, in the kind of defense and electronics space segment. And we made them European champions by bringing them public. OHB is exactly the same. So to answer your question, this whole theme of sovereignty, the security of everything, that's a multi-year theme that we're going to see in Europe playing out over the next few years.
But how do you think about government involvement in space companies? Because I'm thinking about KNDS, right. And I'm thinking about all of these concerns about a kill switch. If a government wants to turn off connectivity, do I not need to be worried as an investor?
So it is very positive for the investment world that Europe finally has made the resolve to invest in critical infrastructure, and space and defense is only one part of it. The Draghi report talked about this. We need 750 billion of capital every year, but only about a third or so is public money. So what really needs to happen is private capital needs to be drawn in. So that partnership of private equity and public money is a long-tested partnership. I just mentioned MTU Aero Engines. That was the sole supplier to the German Air Force for the A400 transport plane a long time ago. So we are experienced. What you need to navigate this environment is experience. It's very difficult for people who haven't done it before.
Let me also ask you about the Bank of England stress tests, these system-wide stress tests, applying to private markets. What regulatory changes are you expecting to come out of those?
So that is a very important development. We are cooperating. We will know the results in, I think, early 2027. It would be premature now to comment on it. As you know, it's an exploratory exercise to really see. I would point towards the fact that private credit as a whole represents only 1% of the whole direct lending market. And very unlike what we saw in the great financial crisis, the whole industry doesn't take deposits or short-term funding. So you don't have some of the same systemic issues that you saw back then. But we have to wait for the outcome of this exercise.
Well, yeah, your big rival Apollo is moving to more frequent pricing on its credit portfolio. Would you say that that's a move towards genuine transparency, or is it just kind of the illusion of transparency?
KKR has always been at the forefront of creating transparency and of educating investors. As you know from following us and looking what we're putting out there in the marketplace, we are absolutely for more transparency. The way to address this current concern is simply more transparency. There will be a difference between people who have done their job in underwriting and portfolio construction and others might not have. The only way to ascertain this is more transparency. Okay,
just finally, AI. Your advice to someone trying to get a start in private equity who's a bit nervous about the threat from AI?
Don't be nervous. I think AI is extremely empowering, in fact. I was the first non-investment banking junior hire that KKR ever made 25 years ago.
Wow.
And, it was daunting, quite frankly. Of course, you had to learn all the tools. You still have to learn the tools. But it will be so much easier to learn the tools with having AI on your side. What will become more important is what really matters, which is the EQ. At the end of the OHB, we had to convince the family folks who has done this for 50 years. You can't have AI convince the family, so that'll become more important.
Okay, the human side. Philipp,
yes.
Thank you for coming to see us. Philipp Freise, KKR's co-head of European private equity there. Great to see you in studio. Well, coming up, as Europe bakes under a record-breaking heat wave, we'll discuss climate change and how investors should respond. That's next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London and these are your top stories. Traders dump tech stocks again. A report that OpenAI might delay its IPO hitting sentiment this morning and the memory crunch forcing Apple to hike prices. An attack on a ship in the Strait of Hormuz, meanwhile, prompts some vessels to pull back, but oil flows continue to tick higher. Plus, Europe continues to bake. Scientists say that the heatwave is officially the worst on record. Well, continuing on that theme, the lingering heat and resulting surge in energy prices come as EU energy ministers meet in Luxembourg, where they face pressure to weaken the bloc's landmark methane regulation. It comes as policymakers gather in the British capital for London Climate Action Week. And I'm joined now by Sarah Kapnick, in town from New York, Global Head of Climate Advisory at JPMorgan. Sarah, really appreciate you coming in to see us while you're in town, especially in all of this heat. And in that vein, I wonder how investors should be responding to this climate change, both from a risk management perspective and in terms of maybe the opportunities that it presents.
Yeah, in terms of risk management, by 2050, if nothing is done, there will be $1 trillion of losses a year if there's no adaptation and resilience. And companies aren't going to do that. They're not going to allow that to happen. So they're investing in adaptation resilience. They see that as a major theme. We also see grid resilience as another large theme, and that intersects with the climate issue as well as with energy security issues that we're seeing right now.
But do you think we're at that critical mass right now? Are European investors treating this as a temporary shock, this heat, or is it that they're seeing it as a structural investment trend?
No, they're seeing it as a structural investment trend, that it is response to this and they will continue to adapt to it. But it shows the stresses that we see today are only going to get worse, because heat waves like this 10 years from now will be over 40 degrees Celsius, and it will keep going. Should
banks be adjusting what they charge clients based on their exposure to physical climate risks?
That isn't in the system yet today. It's very important to be able to analyze that and to be able to start. We're seeing it start to get priced in the insurance markets where there is exposure. The prices are going up, and we're starting to see that in other parts of the market as well.
Yeah, because I'm thinking about, factories in flood-prone areas, vulnerable warehouses. Surely there's a turn that needs to come when it comes to that. But also, when we think about how much role nuclear is going to play in all of this, we've seen the headlines that EDF's had to curtail electricity generation this week from some of its nuclear power stations because of the excessive heat in rivers used to cool the plants. Is the extent to which nuclear is going to play a role being kind of exaggerated?
I don't think so. Nuclear provides low carbon, no carbon energy, but it also provides critical baseload power. Many European countries are investing in nuclear and investing in new types of nuclear that they see as what they need for various issues of energy, but also district heating. I think that it is a trend that is only going to continue as we get closer with these companies actually coming to scale with products online.
So it's reliable?
It's reliable.
Okay. You've also talked about how the massive surge in energy demand from the AI data center build-out, combined with electrification, is putting unprecedented strain on power grids. Is it the grid itself that investors should be focused on as an opportunity?
So the grid itself will see over $1 trillion in investment over the next 10 years across Europe. And that's because of aging infrastructure. It's also due to weather and climate. It's due to exposures of the modernization of the software, and we see that with cyber interests. But then it's also this massive demand growth that we're seeing in electrification first, but then after that, the data centers, and also just reindustrialization across Europe. To be able to reindustrialize and build up more industry, you also need power. And venture capital and private equity have actually already been investing in this space over the last 5 years, and we expect that to continue to grow.
But a lot of the data center build-out is powered by gas. And, when you look at OpenAI, SpaceX, Anthropic, they're yet to reveal their emissions. So, it raises the question, is AI a net positive or a net negative when it comes to the climate and clean water?
We're seeing gas come online, but also solar and batteries to be able to meet the needs. But the long-term offtake contracts that are starting to develop are around geothermal and nuclear. And so it's transition right now as they're building it up, but it's actually majorly solar and battery storage.
Okay. Of course, the Iran war focused minds on our reliance on oil and gas. But now that we've got the memorandum of understanding between the US and Iran, now that there's progress towards a deal there, is there a danger that the urgency around the energy transition fades again?
No, people have memories of this, and with every energy shock that you see in the system historically, you have shifts towards energy efficiency and new types of diversification of energy. And in my discussions with investors, my discussions with corporates over the past week, they're very much focused on this issue of what does the future of the grid look like a decade from now, and how can they plan towards that? And even if there's new natural gas coming online, or you see the LNG build out across Europe, they're still very focused on the build out of nuclear, the capabilities of solar and storage going forward, and also geothermal coming online. We saw one of the first new geothermal plants just go live here in Europe.
But you've got the science accelerating, but the political momentum seemingly slowing, at least when it comes to the White House. How do investors navigate that?
We see variability all around the world, but I would say investors, particularly actually in the Middle East and Southeast Asia, they're going full steam ahead on the transition, and that is because they see it as cheaper. They also want to get off of the volatility and the increased prices of fossil fuels. And so they see it as a self-sufficiency towards energy security, not even thinking about the decarbonization point, but it's a much steadier transition as a result because they are seeing it as a national security imperative that they can't wait for that to take place.
So if you were advising a global CEO today, what's the biggest climate risk that you think markets are still underpricing?
I think the biggest risk is maintaining the status quo and assuming that the status quo is going to be the best strategy going forward. The world is changing around us. There's modernization of technologies, and CEOs need to be thinking about how that all is changing as they look forward to see what they will do 5 years from now, and they need to have plans throughout that.
Okay, great to see you, Sarah. Thanks for stopping by. That's Sarah Kapnick, Global Head of Climate Advisory at JPMorgan. Safe trip back to New York. Well, as the latest heatwave continues to grip Europe, Germany is tackling another problem besides the sweltering temperatures. The Rhine, a crucial conduit for regional energy supplies in Western Europe, is facing shallow water levels that could put a supply crunch on a region already facing disruption. We can get more now with our Bloomberg reporter, Jack Whittels, who covers commodities and climate change. Morning, Jack. Morning. So the Rhine has experienced this before. We know it has. How does what's happening right now compare to history?
Right, so the Rhine, the forecast for next week is for the level at Calbe, which is the crucial choke point on the Rhine, to get into the high 70 centimetre range. Back in 2022, it did get into the 30s, so we're not as bad as them, but that is not to underplay the significance of this situation. Oil barges are severely limited in how much fuel they can carry up the Rhine, and that is coming at a time when Europe is already facing a supply crunch. You know, don't forget that we've banned imports of fuel from Russia, which was previously our main supplier of diesel. We've also closed lots of oil refineries. And, of course, the situation in the Middle East as well.
Yeah, so how does that actually put more pressure on the European oil trade then?
So diesel is our main oil product that we consume in Europe. We consume much more diesel than jet fuel and gasoline. So diesel is shipped up the Rhine into inland Europe. So, you know, if you can't ship barges up the river because the river is too shallow, the way the barges work, obviously, if you put more fuel into the barge, it sits deeper in the water, so shallow river, bottom of the barge hits the bottom, they can't put as much in. So they can't carry as much up the river. At the same time, they're not getting as much supply as usual from the Middle East, plus the Russia sanctions. OK,
so just adding on to the geopolitical issues already there, Jack, sounds like a nightmare. Bloomberg's Jack Whittels, thanks for bringing us that story. Well, turning to autos now, and Volkswagen is reportedly looking to cut tens of thousands of additional jobs and may even shutter factories. It's part of a push to make Europe's biggest automaker more competitive. According to Manager Magazin, the plans include doubling staff reductions to as many as 100,000. Let's bring in Elizabeth Berman, who leads Bloomberg's EMEA Autos coverage now. Elizabeth, good morning to you. What more do we know about these reported VW job cuts then?
For some weeks, the CEO of Volkswagen, Oliver Blume, has been very much emphasizing how the business model for VW essentially wasn't working anymore, which is to develop and build cars in Europe, in Germany, for export worldwide. And the factors behind that are multiple ones. So on the one hand, the Chinese market, which is VW's biggest, is in decline. Local manufacturers there are taking over a lot of the buying appetite. And then in Europe, consumers are also on the back foot, and the company is facing a lot of regulatory burdens. VW, as we know, it's a huge company, and they for many years have been trying to slim down, become more agile, become more efficient. But what's become apparent is that the plans that they made in 2024 are not sufficient to compete with especially the now much more export-focused Chinese manufacturers that are also pushing into Europe.
OK, well, let's see how much these plans get watered down when the Labour representatives get involved. But meanwhile, Elizabeth, you've got Chinese car makers continuing to capture more of the European market, another threat to European car makers.
Yes, absolutely. We reported on the latest figures there, and it's yet another month of record market share for Chinese manufacturers in Europe, pushing for the first time above 10%. That surge has been especially led by hybrid cars, which is interesting in light of the fact that the EU back in 2024 imposed tariffs on fully electric cars. So Chinese manufacturers have apparently been shifting somewhat to offering more hybrid models to consumers, which don't get lobbed with those additional costs for them. And Chinese manufacturers are on a tear because they're able. Sorry, go on.
Sorry, I was just going to say, what's the EU going to do to protect European automakers in that case then?
Well, they could also put tariffs on hybrid and plug-in vehicles, and they may be talking about that already. We're not quite sure. We've heard some rumours, but we're not sure. And they could put in place some measures that require manufacturers to make more vehicles in Europe. And the EU is discussing this as part of the Industrial Accelerator Act, and specifically for car makers, they are working through policy proposals on made-in-Europe vehicles. So that would obviously trigger Chinese car makers to make more vehicles here, and we've seen quite a few deals in that regard already. Stellantis, for example, is among them. They've got a deal with their partner Leapmotor to make Opel vehicles in Spain, also including Chinese technology, and also at a plant that Stellantis owns in Spain near Madrid.
Okay. Adam Munich, Elizabeth Berman, thank you very much for that latest in the auto space. Well, coming up, we're going to turn to tech, Italy's tech renaissance in particular, and how Naples is leading a revival of the South, attracting young talent in their thousands. That story next. This is Bloomberg. Welcome back to the Pulse. Now, South Korea's stock market is slumping today, but it has been on a stunning run, powered by an AI-fueled chip rally. However, extreme volatility and heavy reliance on just a few companies may mean that it's a bubble waiting to burst. Bloomberg Originals has been looking at why South Korea's AI stock mania raises red flags and what it could mean for markets around the world.
South Korea may have an ant problem. Although it's not these type of ants, but rather these.
코스피는 101%예요. 진짜.
There are more than 14 million retail investors in South Korea who are called ants. Individually, they don't have much power, but collectively, they have a greater influence in the market.
And these ants have been busy.
Up by more than 100% so far this year. Just an unbelievable rally.
It's really quite extraordinary what's happening in Korean stocks at the moment.
The Kospi index, which tracks Korea's public companies, climbed 200% over the last 12 months. Compare that to other major markets, like the S&P or even the Nasdaq, and Korea's performance blows them out of the water.
That means it has more than tripled over the past 12 months. Retail investors, they've been the main driver of the Kospi. We can see signs of being a little bit maniac and a lot of people borrowing money to invest in stocks.
And amid the mania is a mounting fear that a bubble will soon burst.
The AI bubble debate is absolutely raging right now.
South Korea is one of the biggest beneficiaries of the global AI trade because it has two of the world's largest memory chip makers.
Korean stocks are really maximizing being beneficiaries of the AI capex bubble. That's the amount of money that's pouring in around the world, but particularly in the US from the mega cap stocks into building AI data centers.
So are South Korea's retail investors building towards the future, or will they get wiped out?
I don't have a strong insight of when it goes wrong. But when the AI bubble collapses, the pain in Korea is going to be extraordinary.
Makes you itchy looking at all those ants. Anyway, that's a sneak peek of this week's Bloomberg Originals documentary, and subscribers can watch it in full on the terminal as well as at our website, bloomberg.com. Well, Well, staying with tech, shares in Qualcomm jumped after it forecast annual sales of more than $15 billion from AI data center components by 2029. The chip maker says data center revenue will be worth $5 billion next year, including $1 billion from custom chips for 2 hyperscalers. The CEO, Cristiano Amon, has been speaking to Bloomberg's Romain Bostick.
$5 billion in fiscal 27. It's a high confidence number that we have based on customer engagements we have right now. Most of the revenue is from custom ASIC engagement that expanded since the acquisition of AlphaWave. And you started to see in that revenue some of this innovative technology we came up for accelerators that doesn't require HBM memory is our high bandwidth compute. And as we keep executing on those customers, we're excited to see that revenue going to about $15 billion in fiscal 29.
I am curious, Cristiano, when it comes to those longer term targets and the bridge between the short term, so what you have put out there for 2027, is there any sense, I know you haven't named the customers that get you over that bridge here, but is that going to fill the hole of that $5 billion based on the $1 billion that we already know is out there?
Look, the $5 billion, as I said, it's, I'll give you the composition. I think what I can say right now, I think, as you'd expect, a lot of those contracts are governed by non-disclosure. We have one large hyperscaler customer in the United States, one large hyperscaler customer in China, and then we have some other engagements that we had on a data center that is all into the $5 billion. So the $5 billion it's a very high confidence forecast to which we have the customers, the capacity, the memory allocation, and everything. As we think about the engagement we have today, and also we talk about a contract that we have with Meta, also for 2 generations of the CPU, especially as we position ourselves for the agentic CPU opportunities, that those engagements are into the $15 billion number. For Qualcomm, as a new entrant, those are great numbers, but really, when you look at the scale of what's happened in the data center, you would imagine as we execute and we show our differentiation, there could be upside, but we're just, being focused on the engagements we have today.
I do have to ask, though, and investors seem pretty pleased with what they heard yesterday about you articulating this longer-term data center strategy. But I'm curious, I mean, you famously exited the data center business back in 2017, 2018, and I know there were a lot of reasons for that went beyond your operational control. But there was a lot of competition then. There's probably even more competition today. Why do you think you can get it right now compared to what it was 8 years ago?
Yeah, look, the circumstances, I think, when we started on the CPU, actually, I know people talk about data centers as a general term, but we started a long time with an ARM-compatible ISA CPU very early. There was a big software barrier. This was before AI. And, at the time, I did not, the market wasn't ready for it, only until later. So it was kind of probably the right decision for Qualcomm at the time. This is a different conversation. It's a different data center right now. This is about AI. But it's a valid question, right? So I will give you the same answer that I gave when we entered the automotive business, when we entered the industrial business, and everything that we have been doing to diversify the company. Those are fast-moving markets now, changing with technology. So where we really focus is not what the data center is doing today, but what the data center is going to be doing tomorrow. The data center is now moving to agentic. That's why you see CPU companies on the rise. You see demand on the rise. The data center is being disaggregated. It's not one single GPU that does everything. You have different hardware. And we're coming out with a comprehensive portfolio. We have a CPU. We have a new memory solution that is not a memory from the memory provider. It's actually been designed by Qualcomm that doesn't require HBM. We have a different accelerator for the disaggregated compute. And we have our semiconductor scale, which is good for custom ASICs. So that's what we're doing. If technology matters and you have fast innovation cycles, there's room for Qualcomm.
The Qualcomm CEO, Cristiano Amon, speaking there to Bloomberg's Romain Bostick. Well, turning now to Italian tech, Naples is leading a regional revival that could be a game changer, both for Italy and beyond. Fueled by a deluge of European Union cash and investments in tech, the city's attracting young professionals, helping it to become a European hub. Let's get more now with our Western Europe economy reporter, Alessandro Alessandra Migliaccio, who joins us from Rome. Alessandra, good morning to you. So I love Milan. Why should young people move to Naples, though?
Well, Naples, I mean, first of all, it offers incredible sights, it's on the water. You have amazing views of Mount Vesuvius and the bay, so that's a good reason. But in the past, as we know, as many of us know, it's been a crime-ridden, difficult city that had trouble developing. What we've crunched some numbers. What we've seen now is that it's growing very, very quickly. Of course, Milan remains, the rich capital of Italy, but Naples, it had growth in 2025 of 0.9%, the whole region. Campania around Naples. The south of Italy in general grew 0.7%. This compares to 0.5% for Italy. So it's quite incredible. I mean, it grew more than Milan. Milan grew just 0.7. Of course, that's because it was, it had a long way to go. So it's just that it's accelerating. And it's not just a one-year phenomenon. We did some number crunching and we looked back. And since 2019, it's been consistently growing faster and a faster pace than the north. So what's happening? Well, you said it. It's tech, it's investments, it's infrastructure, it's European funds that are going into the city, and it's starting to work. And some young engineers are actually coming back to the city. And because the real estate prices are a bit lower than Milan, you can get a really beautiful flat with view of the bay for much less than you would in the center of Milan with no view. So in that sense, that's
well,
useful.
You're selling it to me now. Look, are other sectors benefiting from tax gains in Naples?
Well, for example, it's mostly tech, but it's also industry. For our story, we interviewed a family that owns a business nearby Salerno. Salerno is also benefiting. It's the whole region, and everyone's benefiting because the tech is going into these companies. So they're changing from old-style companies into something more modern, and that's really helping. And it's the university system that's fueling this. You have Apple it created Apple Labs, and so they're investing in training people in Naples. You have Cisco's done the same, Accenture's done the same, Deloitte has hired hundreds of people in Naples. So that's creating momentum, and it's just making the city just a better place to be, with better people and the technology that you need. And also there's a lot of startups. We looked at the numbers, and it's the second city in Italy for startups. So that means there's a lot of young people that are giving it a shot, and they're trying to help the city develop.
OK, so you said it's not quite caught up to Milan yet, but the rate of growth has caught up. How's Naples comparing to other European hubs outside of Italy?
I mean, it's not Paris or London. And yes, you're absolutely right. I mean, Milan is the capital, as far as the capital's Rome, but as far as business and finance and all of that. But yes, the pace has picked up. It's a bit more like cities like Marseille or maybe Bordeaux in France, cities that, we thought they were lost, and now they're really bubbling. And that's sort of what we're seeing. And we're seeing, for example, even the Spanish Quarter, which was a really bad ghetto, the Scampia, which was featured in the TV series Gomorrah. Now there's a medical hub in Scampia. If you go to the Spanish Quarter, it's very much cleaned up. That's also due to Airbnb and tourism. But it's just, I think it's gone past a point where now things are helping each other. So the startups are helping bring in people, the tech labs are helping, and the tourism is picking up as well.
OK, all going hand in hand. Sounds like a positive story. Alessandra, thanks for bringing it to us. Alessandra Migliaccio there. Have a great weekend. Well, coming up on Bloomberg TV, the CEO of BlackBerry joins Open Interest for an exclusive conversation at 3:30 p.m. London time. But we are looking at a miserable session here in Europe. The Stock 600 down 0.8%, and Nasdaq futures down 1.2%. Up next, Bloomberg Brief. This is Bloomberg.